Don't own the stock? Don't worry, because with a single call and a put option, you can now behave like you own it. Welcome to synthetic trading. Welcome back to Stockshaala by Kotak Securities. I am Pranav VK, an NISM-certified trader and trainer, and your options guide here. Today, we are going to learn about synthetic positions, how you can go for a synthetic long position as well as a synthetic short position. A synthetic position is when you combine options in such a way that it mimics owning the entire stock. You don't actually buy the stock, but the profit and loss behaves like stock ownership. There are majorly two types. One is a synthetic long, where it behaves like buying the stock, and the other one is synthetic short, where the profit and loss behaves like short selling the stock. Now let's learn about synthetic long along with an example. To understand the synthetic long position, I've taken the example of Nifty at 19,500. So to enter this position, all you have to do is buy and sell 19,500 call option. So what it does is, or the payoff looks like very similar to you buying one lot of Nifty futures or even holding Nifty stock. So in this synthetic long position that we have taken, you make a profit if the market goes up and you make a loss if the market comes down. Just exactly how it would have been in case you would have bought Nifty futures or all the stocks in Nifty. Here is a small fact. Institutions use synthetic long positions just to mimic the profit and loss of buying a stock, and sometimes they use it just for arbitrage as well. Now let's put some learnings into practice. In the previous videos, I have showed you exactly how to draw payoff diagrams. Now I want you to put that learning into test. So what I want you to do is draw a payoff diagram for buying a call option as well as selling a call option, combine them together and see how the payoff diagram looks like for this synthetic long. Here is a small hint for you to do that. Since it behaves just like Nifty futures, go ahead and look at the payoff diagram of Nifty futures and you'll be able to draw the payoff diagram for a synthetic long position. Now that you know how we can build a synthetic long position using call options, can you think of what you have to do a synthetic short position? Let me know in the comments below. So as you might have guessed, a synthetic short position is an exact opposite of a synthetic long position. So how do we get into this position? Nifty is at 19,500. So what we have to do is make sure that the combination mimics shorting the stock. So we have to buy the 19,500 put option and simultaneously also sell 19,500 call option. And this combination will behave like shorting the stock. And remember, most importantly, that in both synthetic long as well as short, you should always take the positions of the same expiry. Don't take different expiries. Then your P&L is going to change significantly. So in the synthetic short position, you make a profit when the market falls and you make a loss when the market rises. So just like how it would have been if you short a stock. Here's a quick analogy to understand this better. You don't own the car, but you are driving it in reverse, but you're still moving. Institutions and big players use this for hedging large portfolios or even getting short exposure without using the same amount of capital. Now that you have already tried drawing the payoff diagram for a synthetic long, now I would ask you to try it even for a synthetic short position. And the hint is very similar. Since this mimics shorting a future, go ahead and look at the payoff diagram of shorting a future and it will be exactly the same. Now that we have learned a synthetic long as well as short positions, let's compare them for a clear understanding. Here on the whiteboard, I have both of them. A synthetic long position requires you to buy a call option and sell a put option of the same expiry, same strike. Whereas a synthetic short position requires you to buy a put option and sell a call option, same expiry, same strike. The directional view for a long position is that you're bullish, and the directional view for a synthetic short position is that you're bearish on the underlying market. And the risk to reward in this case is owning the stock for a long position and it is like shorting the stock for a short position. If you don't know it, then go to one of the trading platforms where they offer strategy builders. Go ahead and put these numbers: buying 19,500 call option, selling 19,500 put option, and you'll get the graph exactly. Now let's learn why big players use this. They use this majorly for three reasons. The first one is margin efficiency, second is flexibility, and third one is arbitrage opportunities. So the first one, margin efficiency. Instead of paying the entire stock value, they only pay the option margins so that they can mimic the P&L of owning the entire stock. The second reason, flexibility. They use different expiries to time the markets. The third one is arbitrage. If the stock is actually trading at a premium or at a discount to the futures or options, then that creates arbitrage opportunities for the institutions. Here is a pro tip. As a retail trader, you can use this to reduce the capital blocked for entering into these positions compared to actually buying the stock. So let's summarize what we have learned so far. We understood that a synthetic position is nothing but combining two or more options to mimic the P&L of actually owning the stock. A synthetic long position is created by buying a call option and selling a put option of the same strike and same expiry. It mimics buying Nifty futures or futures of the underlying stock. A synthetic short position is created by buying a put option and selling a call option of the same strike and same expiry. It mimics shorting a stock. So these synthetic positions are majorly used by institutions for hedging, efficiency, flexibility, and also mainly funding their arbitrage opportunities. In the next video, we are going to deep dive into strategy. Straddles versus strangles, having extreme moves versus having no move at all. You're watching Stockshaala by Kotak Securities. Make sure to like, share and subscribe. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.